Today we're going to talk about a company's market value versus its intrinsic value and why it's important to use intrinsic value when determining the true value of the stock and the potential long-term earnings, which is an important factor for successful long-term investors. I wanted to start out with a quote from one of our selected readings this week by Tim Plain. The market price of a stock is the result of the desires of buyers and sellers to either obtain or unload the shares. Now, market value can fluctuate a lot over a period of time, largely influenced by the rise and fall of production and output of the company. For example, many times there can be large changes in stock prices following the release of quarterly earnings for a company as investors buy or sell off stock in response. The intrinsic value is seen as the true value, and this is used to compare against market value in determining if a stock is overpriced or undervalued. Intrinsic value is only as good as the information used to determine it, and many sources can come up with very different intrinsic values based on the company information that they have access to. A member of the company may have access to more reliable information than an outside investor with little company knowledge, and thus have a more accurate calculation of its intrinsic value. By reviewing past value, cash flow, and risks associated with the company, an investor can use this information to determine an intrinsic value. There are several models that can be used to determine intrinsic value. One of the most common, the discounted cash flow model, relies on cash flow and the cost of capital. For the weighted average cost of capital, each type of capital is weighted by the percentage of total capital and added together. So why is intrinsic value important? With the right information about a company, an investor can calculate an intrinsic value to compare against market value when making the decision to buy or sell a stock. This allows an investor to label the stock as undervalued or overvalued. An overvalued stock has an intrinsic value under the market value, while an undervalued stock has a higher intrinsic value than the market value. If a stock's current market value is $8 per share, but its intrinsic value is calculated to be $17 per share, the investor stands to benefit significantly by purchasing stock at $8 per share and has room for market fluctuations to occur and still be ahead as long as intrinsic value remains higher than the market value. This type of calculation can be important for new investors and for those with limited funds to ensure they are making decisions to buy that have the best chance to provide value to the investor. An investor can maximize their profits and sell prior to market value reaching its calculated intrinsic value. For your supplemental readings and discussions this week, we'll be looking a little bit closer between the differences of market and intrinsic value, along with the calculation of the discounted cash flow model. For your discussions, we'll be talking about the importance of intrinsic value, along with how different sources can come up with different intrinsic values, and you'll be doing some research on additional intrinsic models.